Hello! In this video, we'll continue with our gross income problem set. We're looking at problem 12. Avocado owns a duplex. Here's the duplex right over here. We have a house, but it has two separate units, so we're calling that a duplex. Now, each unit has a fair rental value of $800 per month. They're identical units. One's on the left, one's on the right, and they have a fair rental value of $800 per month. Avocado, she lives in unit number 1, and then she rents out unit number 2 during the year. So the question becomes, we're looking at gross income. And again, whenever you're dealing with income tax, you always need to focus on 5 questions. First, what amount, if any, is there of gross income? Second, what amount, if any, deductions or credits? Third, when do you have those items? Fourth, who has those items? And then fifth, what is the character? Now, since we're focusing on gross income, we're looking at the what amount of gross income, if any, the when is their gross income, and the who question. So with respect to the who, the only party here that's receiving inflows of actual income is Avocado. So that's who we're talking about here. We're talking about Avocado. The when, we're looking at the same tax year. So it's all within the same tax year of Avocado, that same calendar year. We're not dealing with multiple tax years, which can potentially be an issue. The what, again, we're looking at whether it's actually gross income. So whenever we have gross income, again, we start by defining gross income under the tax law. Section 61 says gross income is income from whatever source derived. But then we go to Glenshaw Glass for a better view of that. Which helps us give us a little bit more better definition. And we look at 3 things. First, there must be an accession to wealth, which means that our net worth, which means assets minus our liabilities, has increased. Next, there must be a realization event. Realization in which there is a legally severable or separable event that's separate from the activity itself that's creating the income. And third, there has to be dominion and control, which means there's no strings attached. DNC in terms of the inflow coming in. So I really see 2 issues here that Avocado has. And I want to go ahead and I want to easily get rid of the first issue. So the first issue is Avocado's own unit. So we're going to break that down into Avocado's own unit. And in the previous problem, we saw a discussion of presumptive income. With respect to presumptive income, for economic purposes, presumptive income is included for economic income. But this is gross income, which is a tax definition, which is separate, which has a baseline of economic, but we use a legal definition to define what exactly what it is that's included for tax purposes. Presumptive, not presumption, sorry. Presumptive income basically deals with one of 2 things. If you own property, like Avocado owns the duplex, and then you use it, the idea is that if you rented it out to someone else, you would record income. But you're renting it to yourself in a way, economically, so you should have to record income from an economic perspective. Well, from a tax standpoint, gross income does not include presumptive income. It's not included because of the administrative concern. Imagine if Avocado had to record every single thing that Avocado did, cook, clean, because presumptive income also includes services that the taxpayer performs for his or herself, because you could charge someone else for those services, but and you do these services for yourself as well. Clean, cook, paint, mow grass, right? All these things. Work, if you do your own tax return, but you're a tax accountant, those are all considered presumptive income, and they are not included for tax purposes, which again is a administrative concern, because it would be a nightmare having to record all those things. You would lose so much track, those things. You potentially could get in trouble. The IRS couldn't keep track. And then valuation. How do you value those things? So avocados, there's no tax, no gross income. There's no gross income with respect to Avocado's unit. But what about the rental unit, unit number 2? The rental unit, Avocado is getting rent, and Avocado is renting it for $800. So this is unit number 2. So we go through our analysis. At the beginning of the year, did Avocado have the rent payments? No. At the end of the year, did Avocado receive the rent payments? We'll assume so, yes. that they actually were paid, and therefore Avocado does get the money. So net worth has gone up because assets have gone up by the amount of rent, the monthly rent amount, which here would be 800 times 12, right? 800 times 12, which is $9,600. So therefore, since assets have gone up by $9,600 for the cash, we do have a net worth increase. And assume in this problem that it was rented from January 1st to December 31st, and they get paid at the end of each, at the beginning of each month. Okay, so we have $9,600 in rental payments. Number 2 is the realization. Well, Avocado is renting out the duplex, right? So this is not a service. So you got to be careful here. But notice that we have the severable item. The severance here is we have the actual unit, which Avocado still owns. And what's separated from that is the money, the $800 of rent that Avocado collects off that. So Avocado still owns the property the same as Avocado owned before and after. Avocado is still the owner. However, you can separate out the money that from that unit, right, that came from the rent. So that's the idea, is you separate the unit owned that Avocado still owns from the actual $800 of rent, which is $9,600 for the year. Finally, dominion and control. Are there any strings attached on the outflow of money, that $9,600? Have to be paid back anyway. Now, if it was a deposit, let's think about deposits. At the beginning, let's say at the beginning on January 1st of this year, Avocado gets a deposit of, let's say, $800, the amount of the rent for 1 month, $800, which will be paid back at the end if everything is as it was. Well, that would be a dominion control issue, because Avocado has to hold on to the $800 deposit, probably put in escrow, and then it's possible that Avocado has to pay it all back. So actually, a deposit, and this is actually under the Indianapolis Power and Light Supreme Court case, interesting case, Indianapolis Power and Light, deposits, and again, there's all different issues of deposits. Maybe a portion is non-refundable, portion is refundable, or maybe it's very likely that when you have a very big power and light company like Indianapolis Power and Light, maybe there's a percentage that almost always gets collected of the deposit. The idea becomes, well, here the $800 is likely to get paid back if, or will get paid back if everything is as it was and there's no issues. We know what deposits are for. What if the tenant completely destroys the property? That can be used to fix and mitigate some of those damages. So there's no dominion control of a deposit, so Avocado would not have to record that deposit. But the rent, there is no strings attached, so dominion control is met. So therefore, all $9,600 is gross income to Avocado, and it's included during the tax year, and that goes on the tax return because all 3 elements of Glenshaw Glass are met, and there's no exclusion. I'm just telling you, you're going to learn more about exclusions later on. There's no exclusion provision out there with respect to, rent. So I hope that helps you. Again, some takeaways deal with the presumptive income aspect of Avocado's unit, rent, and how that goes out to be gross income, and then deposits. Deposits, you got to look at the facts and circumstances, but overall, if there are high strings attached to that, they are not gross income because they fail dominion control. And you can see more discussion of that in the Indianapolis Power and Light Supreme Court case.